Google just beat earnings, they beat revenue, they beat EPS, and yet the stock still went down. Google's parent company, Alphabet Incorporated, reported results for the quarter ending December 31st, 2025. Revenue came in at $113.8 billion, up 18% year over year. Earnings per share were $2.82, up 31%, and net income rose roughly 30%. For the full year, Alphabet generated over $402 billion in revenue, the first time it crossed the $400 billion mark. So, yes, this was a real earnings beat. No accounting tricks, no headline spin. But the market reaction wasn't about the quarter that just ended. It was about what comes next. The most important forward-looking detail from this earnings report wasn't revenue or EPS, it was spending. Alphabet disclosed that capital expenditures totaled $91.4 billion in 2025, including $27.9 billion in just the fourth quarter alone. Most of that money went into technical infrastructure, servers, data centers, and networking equipment, primarily to support AI workloads. Then, management went a step further. They told investors to expect 2026 capital expenditures of approximately $175 to $185 billion. That's nearly double what the company spent in 2025. That single number changed the conversation. More infrastructure spending leads to higher depreciation, higher operating costs, and more pressure on margins and free cash flow in the near term. Alphabet made that clear on the call. Depreciation expense already jumped from $15.3 billion in 2024 to $21.1 billion in 2025, an increase of nearly 38%. Management explicitly said depreciation will accelerate further in 2026 as new data centers and servers come online. So while revenue is growing, costs are growing fast too. Alphabet is still generating massive cash. Operating cash flow was $164.7 billion for the full year, with free cash flow of $73.3 billion. This is not a company with a cash problem. But investors aren't just looking at how much cash Alphabet makes, they're looking at how much of it will be reinvested versus returned to shareholders. And right now, the answer is, a lot of it is being reinvested.